I'm going to give sort of a background on the Rural Zone program and then take you through each one of the tax incentives available to rural zone designees and businesses that locate within those rural zones. And then I'm going to turn it over to Tricia DePadro, who is our job tax credit professional. She is a CPA. And she's going to get a little bit more down in the weeds on actually taking the tax credit and go through the certification form that needs to be filled out and the Department of Revenue form ITRZ. So she's going to go through that with y'all. But just to give you a little bit of background on the Rural Zone program, rural actually stands for Revitalizing Underdeveloped Rural Areas legislation. And that bill was signed into law in 2017. And the purpose was to provide an incentive to stimulate investment in job creation and economic development and the revitalization of rural downtowns. We currently have 35 rural zones around the state. And in your region, we have Villa Rica, Hogansville, West Point, and Woodbury. And these are actually our newest rural zone communities that were just, their life just began January 1st, 2021, and it will last for 5 years. So that designation will last from January 1st, 2021 through December 31st, 2025. So Woodbury and West Point are two of our newest rural zone communities. So the program goals are, like I already said, to try to incentivize job creation and commercial investment and business activity and growth in rural downtowns. And it does this through providing an incentive of a Georgia income tax credit. And there's 3 different ones: the job tax credit, the investment credit, and the rehab tax credit. And I'm going to go through each one of those tax credits individually to explain to you how each one works. First, though, what's a tax credit? Well, it's a dollar-for-dollar reduction in the amount of income tax owed. And so it's generally going to save you more money than a deduction would, because a deduction only is going to reduce the amount of your income that's subject to tax, whereas the credit is going to directly reduce the amount of tax you owe. So these are all 3 Georgia state tax credits. The first one is the job tax credit. And for this one, a business would have to locate within the designated rural zone and create at least 2 full-time equivalent jobs. Or an existing business could expand their business by 2 full-time equivalent jobs and get this tax credit. It's a $2,000 credit per new full-time job equivalent, and the FTE just means that you can add together part-time employees to equal 1 full-time job. So if you have 2 part-time employees working 20 hours a week, 20 plus 20 is 40, so those 2 part-time employees equal 1 full-time equivalent. The businesses that would be eligible to take the job tax credit would be those in those following NAICS codes that you see here, but they include professional services, retail, and light manufacturing, the kinds of businesses that you would want to see in your downtown area. So law offices, gift shops, restaurants, a cupcake shop, vet office, brewery. Did somebody have a question? Okay. But the credit cannot exceed $40,000 a year, but the credit can be taken for 5 years as long as the jobs are maintained. So to see an example of this, let's say that 2 sisters decide to open a women's clothing boutique in Woodbury's rural zone. 2 sisters are going to work 40 hours a week, and then they're going to hire 4 high school students who each are going to work 20 hours a week. So what would be the business's tax credit over 5 years if all of those jobs are maintained for 5 years? Let's figure out how many jobs have been created first. So you got the 2 sisters each working 40 hours a week. So that's the 2 full-time jobs at 40 hours, that's 80 hours a week. And then the 4 part-time high school kids each working 20 hours a week, that's another 80 hours. So that's 160 hours total, divided by 40 hours equals 4 full-time equivalent jobs. And as I said, it's a $2,000 credit per job. So each year, as long as those jobs are maintained, the business would take an $8,000 tax credit for a total over 5 years of a $40,000 tax credit. So that's how the job tax credit works. All right. And let's say that the business didn't have enough income tax liability to use all of this $8,000 in year one. The leftover amount can be carried forward for up to 10 years. Any questions about the job tax credit? All right, well, we'll move on to the investment tax credit. Let me go back. So the investment tax credit is going to be equal to 25% of the purchase price of a building within the designated rural zone. So a developer comes in, he wants to purchase a building within the rural zone. He could take a tax credit equal to 25% of the purchase price of the building, not to exceed $125,000. In the case of Woodbury and West Point, the building has to be purchased after January 1st, 2021 to qualify. And the other caveat is that the business, a business has to be located within that building that's purchased and create the 2 full-time equivalent jobs. So the job creation is key for all of these tax credits. For the investment credit and the rehab credit, you still have to create the 2 full-time equivalent jobs. Doesn't necessarily mean that the developer that purchases this building has to create the job, but he at least has to lease out the space to a business that will create the jobs. The investment tax credit has to be prorated equally over 5 tax years, beginning the year the property is placed in service. So an example of this one would be, let's say a developer purchases a building within West Point's rural zone for $400,000, and his plans are going to be to renovate the second floor into 2 apartments, and the first floor is going to be leased out to a new law office that's going to have 2 full-time employees. So what would be the amount of the investment tax credit if the purchase price of the building is $400,000? It'd be 25% of $400,000, which is $100,000. And remember that it's going to have to be prorated over 5 tax years, and the 2 jobs have to be maintained over those 5 years. So that would be a tax credit on this business's Georgia income tax returns of $20,000 a year. Some frequently asked questions that we get about this: could an investor who purchases vacant land within the designated rural zone area receive the investment tax credit? And the answer to that is yes. If they purchase land and maybe in the hopes of putting in new infill construction on that vacant piece of property, they can. But could the investor then take the rehab tax credit if he constructs that new infill building on the vacant land? No, because the rehab tax credit is only to rehab an existing building. But the investor could take the investment tax credit on the purchase price of the building, so 25% of the purchase price of the land. Sorry, I should have said land. All right, does that make sense? I hate not being able to see y'all because I like to see people nod or shake their head. No, I don't understand what you're saying, Shuri. So any questions, holler out. And then the last one, rehabilitation tax credit. So this is going to be equal to 30% of the qualified rehab costs, not to exceed $150,000. In this case, qualified rehab costs of an existing building are going to be considered labor and material costs. This credit has to be prorated over 3 tax years. And the taxpayer in this case cannot use these same qualified rehab costs to get the rural zone rehab tax credit, and also, in a sense, double dip and use those same qualified rehab costs to get other state income tax credits, for instance, the Historic Preservation Division's income tax credit for rehabbed properties. So you have to choose one or the other, the HPD's state income tax credit or the rural zone tax credit. Also, if the property that's being rehabbed is located within a community that has a local historic district and a historic preservation commission that reviews certificate of appropriateness for any exterior changes to buildings within that locally designated historic district. DCA will accept that COA issued by the Historic Preservation Commission as proof that they're following guidelines, and the building will continue to look historic. But if the rural zone, if the local rural zone does not happen to be in an area that's designated as a local historic district, then the project must comply with our 10 rehab standards, and we would need to look at the proposed changes to the building before any work is done. And I can send everybody out of those lists of rehab standards. But here's an example of the Rehab Tax Credit. Same one we looked at before. The building is going to be purchased in downtown West Point. The business owner is going to spend $150,000 to renovate the second floor into 2 apartments and $150,000 to renovate the first floor into that law office. And the law office is going to have 2 full-time employees. What's the amount of the rehab tax credit? Well, the total rehab costs for first and second floor together are $300,000, and 30% of that is going to be $90,000. And then that credit has to be prorated over 3 tax years, so that's $30,000 per year. The main thing to keep in mind is the job creation. The job creation has to happen for any of these 3 tax credits. And then also always make sure that the business that's going to take, that wants to take the tax credit meets our list of approved NAICS codes. And your rural zone team leader in the case of Villa Rica, that's Janet Chumley. In the case of West Point, that's Megan Duke. Hogansville is Lynn Miller, and in West Point, Steve, and I guess it's Kelly now. They have the list of approved NAICS codes. And can the rural zone tax credits be combined? Can all 3 be layered together? Yes, here's an example of this. The Southern Philosophy Brewing Company down in Bainbridge, Georgia. This is the interior before rehab began, and after rehab, a very successful, I guess you call it a brew pub because they do sell food as well. Got in a nice gathering spot, maybe prior to COVID. I don't think this picture is during COVID, but it's been a successful project. And here's how their tax credits shook out. They were able to create 3 FTEs, so that's a $6,000 tax credit a year for 5 years. They purchased the building for $41,000. So 25% of that would be $10,250. So that's $2,050 per year when you prorate that out over 5 years. They spent about $70,000 on the rehab, so 30% of that is $20,910. So basically, the first year of their tax credits equaled about $15,000. And then over 5 years, their total tax credits that they'll be eligible to earn is $61,160. So any questions before I turn it over to Tricia about the 3 tax credits?
Sure, I don't believe that these people don't have questions.
Yeah, we have a question here in Woodbury, so when you get a chance.
Okay, go ahead.
Is the buyer being employee of that county 2 employees or in other words, is he doing the work or whatever? Can he be considered an employee?
So I don't know if you were able to hear the question, but the question was, if someone purchases the building and they're working in the business, can they be considered an employee in addition to another person that is hired?
Yes.
So long as they receive a W-2 and they're not just receiving distributions or like a 1099, which you wouldn't do probably if that's your own business, but they've got to be like a W-2 employee to where it's recorded what hours and kind of thing that they're getting. Does that make sense?
Says he has an office in the business and he's just one employee and another employee works with him. That's another business in there, that makes two, right?
So the question was if
Yes.
if the investor purchases a building and splits it in half, and there's the owner who is working in an office space in one part of the building and a separate business is working in another part but only has one employee, will that building be considered as two employees for that investment?
Yes. So the investor would be able to take the tax credit because there are actually two employees in his building, but the two businesses wouldn't be able to take the job tax credit because they only have one employee as opposed to the required two.
Thank you.
All right. All right. I'm going to turn
So
it over to
Sheree,
Tricia.
can I
Oh.
ask a question? I'm sorry.
Sure.
Interrupt, but just to piggyback on that, if I understand it correctly, because I learn something every time on these presentations as well. But if a person were to rehab a building and it has, a couple of businesses that are all tenants, the owner, the developer, and investor on that property, can they take are they eligible? I know they're eligible for the rehab tax credit and the investment tax credit, but not you have to actually operate a business to receive the job tax credit.
Right. Right. You actually have to be the business entity that creates the jobs
But
to
you
take
are eligible for the other tax credits, even if you don't have a business that operates
Correct.
in that property.
Correct.
Great,
And so
thank you.
long as the other businesses in there do create the two FTEs.
Do
And like we
create
said
and
in the
maintain
last
jobs.
question, whether it's 1 and 1 or one person creates two, just as long as the jobs are created.
Wonderful. Thank you.
Anybody else? All right. Well, I'm going to turn it over to Trish.
Hi. As Sheree said, I'm going to kind of get into the weeds. The rural zone tax credit certification form is the form that you fill out once you have done all your work. You've made your investment, you've made your rehab costs, and you know that jobs are being created. You can turn it. Okay, so before claiming the rural zone tax credit, the certified entity or certified investor would need to apply for the certification. So you're saying that you've created jobs have been created, and you're either the rehabber or the investor or all three. Someone can do all three as well. The rural zone certification form allows the company to participate in the tax credit program. The certification form is going to include the address and parcel number of the business, and the business must verify the baseline number of jobs prior to the eligibility of the credit, as well as employment during the years that they're claiming the credit. So if the jobs are created and only 2 jobs are created, you're still good the whole time you're trying to take your rehab or your investment or your job tax credit. You don't have to create 2 jobs every year. So once the jobs are created, you're good to go. But you need to be in contact. If you're not the one creating the jobs, you need to remain in contact with the business creating the jobs so that you make sure those jobs are maintained, because any year the jobs aren't maintained, those 2 FTEs don't exist, then you can't take your rehab or investment credit for those years either. The certified entity or the certified investor is going to fill out that form that was a few slides ago, and that's available from your local coordinator, team leader. Then the business fills out part 1, the information of where the business is located, their NAICS code. If they're the business creating the jobs, it must be within that listing that your local team leader would have. They fill that form out, part 1, then they pass it along to the coordinator, the team leader, then who will certify that the business has followed all local ordinances and licensing standards, and then you can click the next one. Then the certification will be forwarded to me for acknowledgement. I will acknowledge it and sign it and send a copy back to the business and the team leader. And that needs to be attached to the income tax return when the credit is claimed. So you have to include that form or you can't get the credit. Because I've had instances already where they haven't attached it and the Department of Revenue's reached out to me. So you must attach it to the return in order to claim the credit. And again, I'm reiterating what Cherie said. The credit can only be used against Georgia income tax liability. And it is a dollar for dollar reduction of the income tax owed. The amount of credits cannot exceed your tax liability. So if your credits exceed the tax liability, that unused credit can be carried forward for 10 years and applied against future income tax liability. Just also to reiterate, the full-time equivalent is the aggregate of 40 hours. That equals 1 FTE. And it can be performed by 1 or 2 people, one or more people. So in Cherie's example, the sisters that own the clothing boutique, they each had 40 hours. So they're an FTE. But if you have folks that are less than 40 hours, then they've got to aggregate to equal the 40 hours. And this is the determination on the ITRZ is the form that will be attached to your tax return. In addition to the acknowledgement letter, which will be a 2-page letter, and the acknowledged certification that we talked about in the last couple of slides. Okay. This is the ITRZ. This is a Department of Revenue form, and this is what will be the Bible for you claiming your credit. The acknowledgement form, the certification form that we acknowledge at DCA, that's going to have your numbers on it. But say your numbers, you have a little bit more of rehab costs or a little bit more of investment costs, or 5 FTs are created and you've only put on the form 2. So that's fine on the certification form if it's not exactly what's on this form, because you file that first form to get the ball rolling, and it acknowledges that you are in the zone and that you've created the job's been created and you're going to claim these credits. Now this form is the official one where you calculate everything on. It's the form ITRZ. The business will fill out part 1. I think it's an extensive form. I think there's a question. Steve?
Yeah, Tricia, I have a question for you. Let's say that business comes into the rural zone in January and they invest $50,000 in a rehab for this business, and we fill out this form and they get the 30% for this year. And in 2022, they come back because they didn't finish the rehab. They come back and reinvest another 50,000. Can they use that as well inside the rural zone?
They can, subject to the limitations, the maximum credit limitations.
Okay, so they could go all the way up to the maximum of $125,000 over the course of the next 3 years, and they would actually extend those 3-year periods all the way through 5 years.
Exactly. And at the end of that 5 years, say you come in on year 4 and you've created the 3-year credit, you still get to take your 3 years, even though the rural zone has ended. That's just saying when you can qualify for it within those 5 years. So say you come in year 5 and the 2 FTEs are created, so that triggers everybody's credits, but also you get to take those credits on those jobs for 5 years. You don't just get to take 1 year because you finally got it together at the end of the time period. It takes time to purchase property. It takes time to rehab property. So it's not expected that in the first year that the rural zone exists, that you have all the components to be able to take the credit. Does that make sense?
Absolutely. Thank you.
You're welcome.
Yeah, can I kind of go off of that a little bit?
Sure.
If I come in and investor buys a building that's vacant today, rehab and create 6 jobs owns the property 2 years, takes his maximum credits or wherever he falls in there, she, and then sells that building at year 2.5 or 3, what happens then?
The credits are lost.
Okay.
They've got to hold on to it to take their credits. Unfortunately.
Yeah,
But that's
kind
kind of the way most of those credits work, is that, you know, if you stop owning a business, then, you know, you don't get that.
well, I'm not so much on the business. You still did the purchase and the rehab.
Right. But yeah, once you sell that building, if you were the investor, then it's gone. You don't get to take them
Yeah.
anymore. So you might as well just hang on
Yeah.
to it the whole time to get your credits.
Yeah.
Unless your carry forward's exceeding anything you can imagine, and you still get the 10 years on that. So even if you leave, that doesn't affect prior returns. They're standalone.
Well,
so you
just
get to have your 10
yeah.
years.
Yeah, just trying to look at it from a perspective that some of these larger structures we have in our downtowns are the ones that need the larger investment, 5, 6, potentially $1 million investment, and that may not be the long-term goal of that investor on a 3, 4, 5 years, but initially to get that credit
Right.
and create the jobs, obviously. So
Right. I'm with you. Yeah, keep turning. It's an extensive form. Each section of the form is for what part of the credit you're taking. In addition to, you see page 5 is the summary. Okay, so depending on what type of credit you're taking, you will fill out the appropriate section of the ITRZ. And like I said, you really need to keep in contact with the business or businesses that are creating the jobs to make sure you're okay to take your credit for any given year. Because if, like I said, the jobs aren't created, well, if they're not created, you don't get to take credit. But if they're not maintained, those other years, you don't get to take your credits. So that's pretty important. You know, this whole thing, this whole credit, any of these credits hinge on job creation. Cherie alluded to, go back, to the NAICS codes. So your team leader will have the listing of acceptable NAICS codes. So if you feel like the business you're creating there does not fall on that list, is not listed, then there is a vehicle to seek guidance when it's not on the listing. So you would petition the commissioner of DCA. In that request, it's a letter written in paragraph form, on letterhead, signed, dated, because believe me, I've gotten them not on letterhead, not signed, not dated. So that's why I reiterate that. So you want to say your timeline of events, circumstances, include the type of business, and be as descriptive as possible why you think this business should be on the accepted list. And then you'll mail or email, the letter to that address. In addition, we have added codes to this list since this started. This is a fairly new program, so Cherie and I will discuss things with Department of Revenue, so that we're all on the same page and come to conclusions. But we just got recently an axe throwing business. They're not listed on the NAICS codes, of acceptable NAICS codes. So we got that business to be able to be in a downtown. So it's not something that's black and white. There are gray areas when we talk about the businesses that you want in your downtown. I think we can turn it, Cherie. Some of the FAQs that we have been receiving since the beginning of this program. Go back.
Sorry.
Okay, the tax credits are not transferable and non-saleable. Kind of what we were talking about a minute ago. If you have those credits. You can't transfer them to someone taking over your business or sell them. Like film credits can be sold, but these are not saleable. And the credits can only be used against Georgia income tax and not against payroll withholdings, which Cherie alluded to the opportunity zone. They get to take against payroll withholdings. The business cannot combine the tax credit with other designations, like the regular job tax credit. However, if the business has created the FTEs, that triggers the investment in the rehab. If that business is also in an opportunity zone and they meet those requirements, they can choose to take the opportunity zone credit rather than the rural zone credit. Since the rural zone credit's only $2,000 and the opportunity zone is $3,500. But as I said, there's much more stringent requirements for the opportunity zone job tax credits. Cherie, did you have something to add to that?
No, but I think that what we're going to do is, since we're kind of running out of time, I think with the FAQs, Corin, if this is all right, we have a bunch of FAQs. So if you send a copy of the PowerPoint to the participants, they'll be able to read through the FAQs. Is that okay?
That works for me. And as I said earlier, we'll make sure that everyone has all of our contact info. So if they have a specific question after reading through everything, that they can email Trish directly or email you directly. So
perfect. Perfect. Thank you.
All right, so Corin, I'll just move right into downtown development. DDRLF.
That'd be great. And I want to go ahead and make everyone aware, when Cherie is talking about downtown development revolving loan fund, that is for any business or property within your core historic downtown, not necessarily just limited to the rural zone. So, the benefits that Cherie and Trish just covered are strictly for properties within the rural zone itself, but DDRLF has a slightly broader scope in some instances.
Very good point. Thank you, Corin. So the DDRLF, the purpose of this program is to help with downtown revitalization, similar to a rural zone program, but it provides gap financing for eligible capital projects in downtowns, and in downtowns in cities and counties below 100,000 in population. The property does need to be located within the core historic commercial district. And our regs say any adjacent historic neighborhoods, but it continues that definition. It's actually adjacent neighborhoods where residential properties are now zoned commercial. So, those houses on the edges of downtowns that have now been converted into, say, a day spa or an attorney's office. Those kinds of businesses would be eligible. But think core historic commercial district tight in, as opposed to out along the gateways that are coming into your downtown. Typical eligible activities for the Downtown Development Revolving Loan Fund are land acquisition, building acquisition, new construction, maybe somebody purchased land and is now doing infill development, renovation of an existing building, or combinations of these. And by far, we do mostly building acquisition and renovation of historic buildings. Some activities that are ineligible are working capital and operating expenses. We will not refinance a permanent loan. We can't pay for loan administration costs, and we don't allow our money to be used to set up a local revolving loan fund. As I said, our program is gap financing. So if you're a business that's looking for financing, your first step is to go to your local bank and talk to them. Only if they're unwilling to loan you the full amount should you then talk to us and apply to our program. As I said, we are gap financing only. So only if there's a gap can we come in and assist. And typically our loans are structured 50-40-10, with 50% of total project costs coming from bank loan, 40% coming from us, and 10% owner equity requirement. Our maximum loan amounts are $250,000, but our loan can't exceed 40% of total eligible project costs. So that's where we come in, is that 40%. Minimum loan amount is $50,000. And I'm sorry that you're hearing my dog bark.
Hey, Sheree.
Yeah,
I
this
was
is
about
Holly.
to say,
Are we supposed to be seeing the DDR screens?
yes.
We're still
not.
on the FAQs for the tax credit.
Oh my goodness.
and I was about to ask everyone to mute their thing.
And it's
Because
me.
your
It's
dog.
my
And
dog.
it's Sheree.
Dang Max.
You stupid Max. Hold on, you
least it's
guys.
not my dog.
I'm so sorry. Why didn't y'all holler at me? Okay, hold on. Let's try this again.
I think technical difficulties and dogs barking are just the new world order. So
I think so. I think it's a COVID world.
Good grief.
I had to get up and let all three of mine out during when we first got started. I knew better.
You guys, I'm so sorry.
And your dogs
Okay.
are huge, Holly, so they probably have a really bad bark.
Oh, it would deafen everybody on the call.
Okay, guys. So
Okay.
anyway,
Thank you.
this is where I was. So maximum loan amount of $250,000, not to exceed 40% of total project costs. We don't make any loans less than $50,000. And our interest rate is at 3%. But for Main Street cities that have that designation and they're in good standing with the program, we can offer 2% interest rate. The terms are a 15-year term with a 15-year amortization, and we don't have any application fees or loan origination fees. And Georgia Cities Foundation is our sister loan program, and that's what Chris Higdon's going to talk about next. So he'll talk through the ins and outs of that program. But we can often do larger projects together, and then the two of us put together would not give more than 40% of total project costs in those bigger projects. Our maximum loan amount is $250,000, and I think Chris's is $200,000. So just a few differences that he'll point out. So for us, DDRLF applications are accepted year-round. We have a pre-application that we call an IPA, an initial project assessment. DCA's regional reps, and for this region, that's Karin, and she can come and talk you through the program and also do the required IPA site visit to get you set up and can answer all DDRLF questions you have. But the application really must demonstrate that there is community support in general for downtown revitalization, and we want to know that this particular project, whether that be a renovation project or infill project, definitely fits in with the community's plans for downtown revitalization. We love it when applicants cut and paste from their downtown strategic plan or their comprehensive plan, and they cut and paste exactly those goals outlined and how the project fits in with those goals. We want to see that the project is going to have a positive impact on downtown, particularly with job creation. We love those projects that take a blighted, unused, vacant building, renovate it, and then create maybe a commercial unit in the first floor and some residential units above. So you've removed blight from your downtown, you've created a new business, you've created jobs, and you've added residential above to generate foot traffic in the downtown. So we'd love to see those kinds of projects. We want to know that the project is feasible and sound, and that, of course, the borrower is creditworthy, and all applications will be run through our credit team for underwriting. So those are the things that we're looking for. If you go to our website, you can find the DDRLF fact sheet and that IPA, the initial project assessment, our pre-application. Once you are you sort of vetted through that pre-application, then you're invited to submit a full application, and the full application's on there as well. Wanted to give you an example of a DDRLF project. And sorry, didn't have y'all on that mode. But this is the Mystic Grill in Covington. Really cool project that happened a few years back. This was a building that had some fire damage and was vacant in downtown, but it was serving as the facade of a building called the Mystic Grill in the Vampire Diaries television series that was on for like 8 seasons on TV. 2 couples purchased the building in order to play off the success of the television show at the time, and then just to offer fans who were already coming to downtown Covington a sort of a Mystic Grill experience. The building was renovated as a restaurant and event space that looks and feels similar to the one portrayed in the TV show. The bar is actually a replica of the one in the TV show. And there's also a beautiful rooftop bar that overlooks the downtown historic courthouse square. This is the source and use for the project. So you can see total project costs were about $1.8 million. DDRLF came in and provided $250,000. And GCF, Georgia Cities Foundation, that Chris is going to talk about next, also came in at $250,000. We helped pay for the renovations. And then Newton Federal Bank had $845,000 of total project cost, and then the 2 couples provided $450,000 for the total project. So there's also a vampire gift shop in the basement where you can buy vampire merchandise and other merchandise from other TV shows that have been filmed in Covington, like Legacies and Sweet Magnolias, and the originals. So a neat project in downtown Covington that's very popular. About 40 jobs were created here, and it definitely, they say that this has spurred more restaurants to come into downtown Covington and really helped spur economic revitalization in downtown. Questions on DDRLF before I turn it over to Chris? All right, well then, Chris, I'll give it to you.
Thanks, Sheree. Do you have that slide with my contact information, or it'll be included in the?
It will be included.
Sent out to everyone. Okay.
Yeah,
great.
I have it. It's
Well, thanks
just
everyone.
I can't share my screen.
No problem. No problem. The Sheree makes my job easy because our programs are very similar. So you've heard a lot of how Georgia Cities Foundation works. So I'll mainly add a few things to that and tell you some of the key differences between our programs. I will kind of add, I'll first off saying when I introduce myself, I said I work for the Georgia Municipal Association, and for those in the presentation that aren't familiar with GMA, it's the original GMA, not Good Morning America. We're an association that represents all the cities in Georgia. And the foundation was created 21 years ago to help cities with their downtown revitalization. And our loan program came out of the ground at the same time with DDRLF. So we've been partners in this from the very beginning. Our funding is, we're a 501c3. It was created by GMA. Our funding is primarily private donors for foundations, and occasionally some federal grants, where the state's funding is comes from the state legislature. So we created these programs to help with the revitalization, to help. We were hearing from our cities, our downtown managers. We have trouble getting people to invest in our downtowns. And when they do want to invest, they have trouble getting financing. So that's the key to the gap financing that Cherie mentioned, because the gap financing essentially does two things. It lowers the risk for the banks to invest in the project, because we take a second lien position, which lowers their risk, lowers the amount that the bank has to put into the deal, that makes the numbers work on their end. It also essentially helps lower the equity requirement that the investors have to put into the projects, and to make the banks happy, essentially. So that gap financing piece, for years, we really both promoted our programs for being low interest programs. Historically, they've been very low interest. It's hard to be low interest in the current environment, although we still are a relatively low interest. But what really helps move the needle more than anything else on these projects is providing that gap financing need. So I wanted to mention that. Our programs are very similar. We both provide the subordinated financing. All the same rules apply for our program in terms of what we will and won't put our money towards, that Cherie mentioned. We only provide permanent financing. I'm not sure if that was mentioned, but all that really means is we don't do construction financing, although our applications usually come in prior to construction beginning, or at the latest in the very, very early stages of that process. And then we will provide a loan commitment. And then once the project is complete, then we will close on our loan. Like DCA, our programs flow through the Downtown Development Authority. So, and that's an idiosyncrasy that we could cover in more detail later if anyone's interested. But we also we do have some fees. I like to say we don't have the benefit of state taxpayer support like DCA does. So we do have some fees in a somewhat higher interest rate, where DCA's is 3% for most cities. Ours is 3.5%, and we do have an application fee and a loan origination fee. But if you talk to bankers, you realize that the fees are relatively low. There's really not too much more for me to add, except to just mention that because we are a nonprofit and not a program run through a state agency, we do have a little more flexibility on projects than DCA does. We do participate in projects together a lot, but sometimes there's a project that DCA is okay participating in and we are not, and probably a little more oftentimes the case it's the other way around. So I usually do tell folks that if a project is deemed to be ineligible for DDRLF and you haven't spoken with me, don't automatically assume that it wouldn't be eligible for GCF, because we may be able to be a little more flexible on the qualifications. Otherwise, I will pass the program over to Holly if there aren't any questions. It's mostly for you to know that there is more than one loan program out there. Oh, and I did want to add, Cherie was correct. Our maximum loan amount currently is $200,000. Historically, it is also $250,000, but our revolving loan fund is low on funds right now. We're seeking additional funds while we wait for loan repayments to come back in. But until we have additional funds, we had to lower our maximum loan amount. Are there any questions for either of our loan programs? And if there are, and you don't want to ask now, just reach out to me later. That's what I'm here for.
Steve, you have your hand raised. Do you have a question?
No, ma'am, I tried to turn that off earlier, but it won't go away.
Okay.
Well, Holly, it's your go.
Okay. I will see what I can do. Give me a minute. Everybody knows I am technically challenged.
I'm feeling your pain today, so.
Can everybody see that?
Yes.
Okay. I do want to apologize beforehand. My home office is in the mountains and it's a rainy day. So if I freeze, I apologize for that. If I do, Corin, will you send me a text message or something? Because I don't have my email up while I'm talking.
Yeah, we'll let you know.
Okay. All right. First of all, I want to let you know this is a gap financing program. It is a direct program straight to the small business. We don't go through a municipality or anything. But this is really important for the municipalities to know about, because as you're trying to recruit businesses into your areas, sometimes you'll run across a business that you're trying to help that may approach your local banks, and they may have some gap financing needs. In this case, you'll need to know about Ssbci, and you can reach out to us, and we can help them find an approved lender in the program. You can reach out to us to ask if it's something that would be eligible. And this, for the small businesses that are on the call today, if you go to a bank and they would do the loan, except for perhaps you don't have the down payment, the cash equity that they want you to put into the business. Perhaps you want to keep your cash equity for your operating expenses instead of having to borrow on a line of credit in order for your operating expenses. This type of program would be particularly good for you for the gap financing. Again, you have to be credit worthy, but this is particularly good for gap financing. So with that in mind, and I do want to point out before I forget, Chris Higdon with Georgia Cities Foundation does participate with this program. Once his loans go from construction to permanent, if he needs us for some gap financing for the borrower, he will enroll his in our guarantee program, and we will talk about that in just a few minutes. But this is my contact information. Because I am teleworking most of the time, my cell phone number is the best way to reach me, or my email address. So we're going to talk about access to credit for small businesses, and we're going to talk about two programs. First, I want to talk about the Ssbci program, and again, that stands for State Small Business Credit Initiative. And so, why Ssbci? Well, it came about in 2010 when the economy was so terrible. We all remember that, and it was a federal program that came down, and we finally rolled it out in 2012. And you know, banks were closing. Larger banks were not lending to the smaller businesses. The larger banks were buying up the smaller banks, and just kind of getting rid of the small businesses that didn't have the big deposits. Fast forward to COVID-19 last year, and the small businesses were out of luck. And now it looks like we're losing even more small businesses. And so once again, Ssbci has just gotten crazy busy. And so now it's extremely relevant once again. And there's even talk in Washington of another round of Ssbci. So when back in 2012, state of Georgia received right at $48 million. And with that $48 million, as of December, we had revolved that money up to $66.4 million in loans with Ssbci money. We've made 610 loans around the state of Georgia. We've been able to leverage that with 343.8 million of bank or financial institution loans. That is 343 million in loans that they normally wouldn't have done without the help of Ssbci. That's a caveat of the program. Created or retained over 5,700 jobs, and we are now in 84 counties. And I wanted to show you how we laid out. Now, I know you can't see the details of this map because it's so small. And if we were in a face-to-face situation, I would be passing out the maps right now for you all to see. But you get a general idea of where you're at on the map. You know where your counties are on the map. So you can see kind of where we are. I would like to be in all counties. And all of our regional reps do a wonderful job of calling me when they see that there's a project out there that would be eligible for Ssbci. But for you, the businesses, and for you, the county, the municipalities, now you know about the program, and you can reach out to us, to me or Tim Smith. Tim, I think you may be on the call. If you are, I'll get you to introduce yourselves after the presentation. But either one of us can help you with eligibility questions. And we basically have two programs that we operate now. One is called the Small Business Credit Guarantee Program. We call it SBCG because you know we love acronyms. We just love them to death. And then Georgia Loan Participation Program, we call it the LPP. And so some advantages. Both of these programs give the banks credit enhancements. We give them credit enhancements so they can in turn get comfortable with making the small businesses loans. It's a delegating lending model. They love that. What does that mean? It means that they use their own underwriting criteria to make these loans. We don't dictate to them how to underwrite the loans, because I guarantee you, every bank in Georgia has a different set of underwriting guidelines, and you know, we're not going to dictate that. So that means they set their own rates and terms. Some of them don't do certain industries. Some of them like to do poultry loans. Some of them like to do medical related loans. It really depends on where they are in the state. Some don't do restaurants. So it just depends. They get potential for CRA credit if they make loans to distressed areas with the help of Ssbci. And that was the whole mission of Ssbci in the first place, was to help small businesses in distressed areas. So we do a lot in the rural areas for that reason. It's a very streamlined process. The bank does their underwriting. They send us just a very few forms. We review them and they're out the door. So we only add about a week to a week and a half onto the approval process, and that's very good for the bank. It helps the bank increase their loan portfolio because they're doing loans that they otherwise wouldn't be able to do, and it gives the small business access to affordable credit. With our credit enhancements, they don't overcharge the borrower on interest rates. In some cases, they can do a market rate or even below market rate because they've got our help. And I'll explain that in just a few minutes. What can we do? We can do startup cost and working capital. Now, y'all know if you walk into a bank and ask for money just to start a business or working capital, the banks don't like that. But with our program, we've been able to do a lot of that. We can help purchase businesses, franchise fees, equipment and inventory, purchase, construction, renovation, tenant improvements. I will say that refinancing is not eligible. If a bank currently has a loan and they want to refinance at midterm, which means it's not at maturity, they cannot enroll that. We consider that enrolling a bad loan. If it has to be refinanced, then it's probably refinancing for not a good reason. The whole purpose of this program is to get new money out on the streets. And so if a bank's trying to refinance a current loan, it's not getting new money out on the streets. However, if small businesses, if your loan at a current bank has reached maturity and you need new money for expansion, let's say you need new equipment, let's say you want to add on to your current business, let's say you're a restaurant, you want to add a catering business. And so you want to renew your loan, let's say it's had a balloon note or something, and you want to ask for at least 10% more new money, then yes, we can enroll that loan as long as the original purpose was eligible. And we have done a lot of that. But remember, it has to be at maturity or coming up on a very close maturity for us to do that. And we can do that. No passive real estate investments. It must be owner occupied. So no investment properties. And so let's talk about the Georgia Loan Participation Program. This is our most popular with our banks. We do 99% of our business with LPPs. This is a 25% loan participation. We can participate up to 25% on a bank's loan up to $1 million. We are capped at $250,000. So if a bank comes in with a loan for $1.5 million, $2 million, we can still participate. It's just that we're capped at $250,000. That's still a pretty good amount. It still can help with a 10% down payment, if you will. It just doesn't get them to 25% down payment. And sometimes that's enough for banks. We have a lot of banks that participate, and they only ask for exactly what they need. It might be 11.5%. It might be 15.6789%. But we're just there for whatever the bank needs us to participate with. We can do bridge financing with SBA 504s. Some of the businesses in the room, so to speak, may be familiar with SBA 504s. Some of your smaller banks, your more rural banks, your local banks, may not be able to go 90% at risk during construction phase if it's a larger loan. We are able to come in during the construction phase and participate with the bank up to 25%, up to $1 million. And then when SBA takes the debenture out, they just take us out. And that helps the bank get comfortable with the loan and get you into that 504. Or you can just skip the 504 and go with the LPP. Why would you want to do that? Because there are no fees to participate in the LPP program. No fees to the lender and no fees to the borrower, and very minimal paperwork. If you've ever been involved with an SBA 504, you know what the file looks like and you know what the fees are. So again, why the banks like this is because we are always in second lien position behind the bank. That's huge. Pardon me. When the banks participate with other banks, they're in a shared first position, and both banks take fees. When they participate with us, there's no fees, and we're in second lien position. Also, both banks are trying to get the deposits for the company, the small business. We don't want the deposits. So it's really a win-win for the small business and the borrower, the lender. Let's talk about the SBCG. Are there any questions on the LPP program before we move on to the guarantee? Any questions? Okay. For the credit guarantee, it's just a 50% loan guarantee. Easy as pie. We can go up to $400,000 with a $200,000 guarantee. If the loan is over $400,000, we still have a cap of $200,000 on the guarantee, and we've done a lot of. This program is good for line of credits where LPP can't do line of credits. This one can. So we've done several $1 million line of credits, and we just guarantee 200,000 of it because that's our max. This one does have fees because we don't earn interest on our portion of the money, because all we're doing is we're setting aside that 200,000 on the general ledger. It's just sitting in an account earning nothing. You all know what your savings account earns if you have a savings account or a money market. So we just get a processing fee of $100 on this one. We have initial fee of 2% on the guaranteed amount, not the loan amount, but the guaranteed amount. And then each year the lender pays 0.5% of the outstanding guarantee or the outstanding balance if it's a term loan. They can pass that to the borrower or they can just pay it themselves. And so that is how that works. Are there any questions on Ssbci before I move on to Garja? Anybody? I can't see if anybody's got their hand raised. I don't have that screen up. Okay.
There don't appear to be any questions in the chat either.
Thank you, Corin. Appreciate that. So Garja is called the Georgia Agribusiness and Rural Jobs Act. Now, unfortunately, it looks like not all of you on the call are included in this one. Where Ssbci can go anywhere in Georgia, it doesn't matter about population or geographical location. Garja has some limitations, but we'll talk about that. Now, this program is a tax credit program. DCA does not have the money. We have what's called rural funds, and the rural funds have the money. We are their regulators, okay? We regulate them and make sure they're doing what they're doing, they're supposed to be doing. And so basically, this was enacted in 2017. We finally rolled it out in 2018. It's a $100 million program. It's a capital investment program. And with that 100 million, there are 60 million in tax credits. Now, who got the tax credits? The insurance companies got the tax credits for their part of their investment. Basically, they put in theory, the insurance companies put in 50 million, banks and other individuals, investors put in the other 50 million. The individuals and banks get interest. Their income is the interest earned on the whole 100 million in loans that go out, and the insurance companies get tax credits back of 60 million on their 50 million that they invested. And so they had 2 years to get this $100 million out. And so that they had until June 30th of last year, 2020, and they did. So now they're working with revolving loan funds. All right. There's also legislation coming up in this legislative session for another round of Garja. So I wanted to let you know about this because A, they have revolving loan funds that they have to keep revolved for the next 5 years. And B, there may be another round. And I think they're going for another 100 million. So it's very important for y'all to know about that for those that are currently included. I do know right now it's for counties with 50,000 and under population. I do know that they're trying to increase the population, I think, to 75,000. So just kind of watch that. I don't know what the legislative House bill is or Senate bill is right now, but I'll let Cora know, and she can help watch it through. So GARCHA funds can be used with term loans, line of credits, or equity investments. They did have to have 10% of agricultural loans in equity investments, and they did that. So they don't have to do equity investments anymore. Most of them are term loans. Their maximum investments was $6.5 million. So these were big loans, and they did a lot of $6.5 million loans. Now, right now they just have revolving loan funds. So some of them have like $1 million, some of them have 500,000. It just depends on how they're paying back. They have to have a term of at least 1 year, and really uses can be just about anything on this one. The businesses have to be 250 employees or less. They have to be in one of these industry sectors. They have to be agricultural, of course, manufacturing, healthcare, technology, and transportation. There is a complete listing of our next codes and eligible counties on our website, the DCA website. And if you go to Community and Economic Development, search for GARCHA, and it'll be on there. If you can't find it, email me and I will send you the list. And of course, it has to be in counties less than 50,000. Here's where it lays out on the map. So anything that you see in the tan colored counties are the eligible counties. So I wanted to let you know what they've done so far as of 6:30. There's about 38 loans in 23 counties, and this is how it laid out. A little over 50% was in the manufacturing area, a little over 50 million. Agricultural was 24 million. Transportation and warehousing, 18 million. Healthcare was about 7.5 million, and other was $1 million. So actually they did 101 million. It's kind of hard to make the loans come out exactly to 100 million, and some of them put in their own money just to make the deal work. So that's how that played out. And this is where it mapped out as far as where they were located. So I know you can't see that, but when you get the slideshow, we are also going to have we're working on a publication for public viewing that will actually give you a list of exactly where how much was done on each loan in each of these counties. Slow going. It'll be out eventually. And that is it. Do I have any questions? I'm going to leave it here in case anybody wants to ask something specific.
Yeah, and I'll make sure when I send out there's a terrible echo. I apologize. When I send out the handouts that will include maps in a larger format. Holly, if you could maybe. Okay. Sorry, there's a lot of feedback. But as I was saying, we'll make sure that the handouts that we send out include larger versions of some of the maps that are embedded in the PowerPoints, just that you can see those.
Hey, Tricia, I had a question for you. So last year was a tough year, right? Because COVID really took an impact on the majority of our businesses, and a lot of our businesses moved their employees, especially if they were part-time, into unemployment. So they redacted them off of the roster, if you will. And If we look back at last year and there was a significant reduction in the number of employees, let's say they went from 10 to 5 because of the move to unemployment. So if they come back in January, and since they only had 5 full-time equivalent for 2020, if they come back in January and they actually put those 5 additional full-time equivalent back to work and we move from 5 to 10, does that qualify as 5 new jobs?
So you're saying you had 5 or you had 10 originally?
Well, in January of 2020, we had 10.
Okay.
In March, we moved 5 to unemployment. So we went from 10 to 5 employees, and we kept 5 employees from March through December. So if
Well,
you
in
do
fact, you kept those 5 all year, and were they prior to 2020? Were they, you know, the 10 was there, or was it just 5?
Yep, prior to 2020, the 10 were there. But this is our
Okay.
first year inside the rural zone, so we count from 2020 to 2021. So if you look at the numbers, if you do the aggregate for the entire year, we may have 5.3 and some change if you do the math. And then we move up to a full 10 employees January 1st because we employed those 5 full-time equivalents back into the roster. Does that mean that we added 5 jobs?
It means that you'll be able to still take the credit on the folks that qualify for that year, and the person that was perhaps doing an investment or rehab will be able to count theirs because you had more than 2 full-time equivalents.
Right, because we added more than 2 full-time equivalents back into the roster. All right, good, thank you.
You're welcome. And if you have questions when you're looking at the form as well, feel free to reach out to me. This program is so new that sometimes it helps to see it, written down, on the form.
Yeah. Okay, thank you much.
Sure enough.
Yeah, and I think a good just rule of thumb also is, we at DCA, we don't offer legal advice or any, that sort of advice. So make sure that that your businesses are working with local accountants and local legal counsel on some of these issues as well. So.
And I've always said, whether it's this program or the job tax credit program, if somebody wants me to look at something before they file it and we can work through the scenario, then I'm more than happy to look at something for you.
Yeah, so please take her up on that. That's great. It's great assistance. Any other questions? Is that Coleman trying to speak? So, well, as I said, this is not the beginning or the end of our technical assistance. So when we make those slides available to you, it will have everyone's email address. So you can reach out to the presenters directly. You can reach out to me, and we'll make sure that you get the questions that you have answered and the information that you need. These are some great tools, and hopefully we know that 2021 is going to be a rebuilding year for a lot of our downtowns, but I still think that downtown is where it's at. So we're going to see people want to continue to be downtown and invest downtown. So we hope to see a lot of activity generated through these programs. Any other thoughts, comments, questions? All right, well, I will go ahead and adjourn this meeting. And as I said, we will be sending information, copies of the slides, and also a copy of this recording will be on the Georgia Department of Community Affairs Agency YouTube channel as well. And we'll let you know when that happens. So I hope to see you all soon. Thanks and have a great day.
Thanks, everybody.
Thank you. Thank you.
Thank you.